Three financial crises, same hidden cause. 1987, Black Monday. The stock market crashed 22% in a single day. 2008, the Great Financial Crisis. Lehman Brothers collapsed. AIG needed $180 billion to survive. 2025, right now. Each crisis was triggered by the same financial weapon, a market that almost nobody understands: derivatives. In 1987, the derivatives market was worth $1 trillion. In 2008, it was $60 trillion. Today, it's $600 trillion, 10 times bigger than the crisis that nearly destroyed the global economy. Warren Buffett called them financial weapons of mass destruction. He was right, and the next detonation will be unstoppable.
Derivatives don't collapse randomly. They follow a pattern. Three major crises in the last 40 years, each one bigger than the last. Let me show you the progression. October 1987. Black Monday. The Dow Jones dropped 22.6% in a single trading day, the largest one-day percentage decline in stock market history. What triggered it? Portfolio insurance, a derivative strategy where institutions used options and futures to hedge against stock market losses. The theory was simple. If stocks fell, the derivatives would automatically trigger sell orders to limit losses. But when the market started dropping, every institution using portfolio insurance started selling at once. The selling triggered more derivative sell orders. Those sell orders triggered more selling, a feedback loop. Within hours, the entire market was in free fall. The derivatives market in 1987 was worth roughly $1 trillion, small compared to what came next. September 2008, Lehman Brothers, the fourth largest investment bank in America, filed for bankruptcy, the largest bankruptcy in U.S. history. Lehman had over $35 trillion in derivative contracts when it collapsed. Let that number sit for a moment. 35 trillion. Every institution that had traded derivatives with Lehman suddenly faced massive losses they hadn't anticipated. AIG, the insurance giant, had sold hundreds of billions of dollars in credit default swaps, derivatives that were supposed to insure against mortgage defaults. When the housing market crashed, AIG owed more money than it had. The US government injected $180 billion to prevent total collapse. Bear Stearns collapsed. Merrill Lynch was forced into a merger. Washington Mutual failed. The derivatives market in 2008 was worth approximately $60 trillion. The global response? $29 trillion in bailouts and guarantees to stabilize the system. But the system wasn't fixed. It was made bigger. Today, 2025, the derivatives market is worth over $600 trillion. $600 trillion. That's more than 6 times the entire global economy, more than all the money, all the assets, all the wealth on Earth combined. And it's built on the same leverage, the same complexity, the same counterparty risk that destroyed the system in 2008. Three crises: 1987, 2008, 2025. Each one 10 times larger than the last. The pattern is clear. The next explosion isn't a question of if, it's a question of when.
Most people have never heard of derivatives. Even professional investors struggle to explain them clearly. But these instruments underpin every major bank, every pension fund, every insurance company on Earth. So what are they? A derivative is a financial contract whose value is derived from an underlying asset. That sounds simple. It's not. The underlying asset can be anything: a stock, a bond, a commodity, an interest rate, a currency exchange rate, even the weather. The critical thing to understand is this: you don't need to own the underlying asset to trade a derivative. You're just betting on which direction it will move. It's like buying insurance on your neighbor's house burning down. You don't own the house, you just collect if it burns. The most common types are futures, options, swaps, and credit default swaps. A futures contract lets you bet on the price of oil or gold at a future date without actually buying barrels of oil. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price. A swap is an agreement to exchange cash flows, like trading a fixed interest rate payment for a variable one. Credit default swaps are insurance against bond defaults, except you don't need to own the bonds to buy the insurance. Now here's where it gets dangerous. The notional value of a derivative is the face value of the underlying asset, but the actual money at risk is usually much smaller. If a bank enters a $100 million interest rate swap, the notional value is $100 million, but the bank might only put up $1 million in collateral. That's 100-to-1 leverage. If the bet moves 1% against the bank, the collateral is wiped out. If it moves 2%, the bank owes money it doesn't have. Multiply that by thousands of contracts across dozens of banks, and you have a system where a small market movement can trigger cascading failures. Bets stacked on top of bets. Leverage on leverage on leverage, until nobody actually knows who owes what to whom. And that's when the system collapses.
Let me show you exactly how derivatives destroyed the financial system in 2008. It started with mortgages. Banks across America were issuing subprime mortgages to borrowers who couldn't afford them. Those mortgages were bundled together and sold as mortgage-backed securities. Then Wall Street created derivatives based on those securities. Credit default swaps. A credit default swap is supposed to be insurance. If you own a bond and you're worried it might default, you buy a credit default swap. If the bond defaults, the seller of the swap pays you. Simple insurance. But Wall Street turned credit default swaps into side bets. You didn't need to own the mortgage-backed security to buy a credit default swap on it. Investors who had no exposure to mortgages could gamble on whether those mortgages would fail. AIG, one of the largest insurance companies in the world, sold hundreds of billions of dollars worth of credit default swaps on mortgage-backed securities. They collected premiums every month. Easy money. But AIG didn't set aside enough capital to pay out if the mortgages actually defaulted. They assumed housing prices would keep rising. They were wrong. When the housing market crashed in 2007 and 2008, the mortgages started defaulting. AIG suddenly owed tens of billions of dollars it didn't have. If AIG collapsed, every major bank that had bought credit default swaps from AIG would face massive losses. Goldman Sachs, Morgan Stanley, Deutsche Bank, Société Générale, all of them were exposed. The US government stepped in with $180 billion, not to save AIG, to save the banks. But AIG was just one institution. Lehman Brothers had $35 trillion in derivative contracts when it collapsed. Every institution that traded with Lehman faced sudden, unexpected losses. This is called counterparty risk. If Bank A owes Bank B money on a derivative and Bank A fails, Bank B doesn't get paid. Now Bank B can't pay Bank C. Bank C can't pay Bank D. The failure of one institution cascades through the entire network. Credit markets froze. Banks stopped lending to each other. The global financial system nearly collapsed. It required $29 trillion in bailouts and guarantees worldwide to stabilize the system. $29 trillion. And the derivatives market then was $60 trillion. Today it's $600 trillion, 10 times larger. When the next crisis hits, there won't be enough money in the world to bail it out. The lesson from 2008 should have been to ban or severely limit derivatives, especially the most dangerous types. Naked credit default swaps, where you're betting on bonds you don't even own. That didn't happen. Instead, the derivatives market exploded. From $60 trillion in 2008 to over $600 trillion today. Why? Because derivatives are profitable. Banks make billions in fees trading them, Hedge funds use them to generate massive returns with minimal capital. Governments use interest rate derivatives to manage debt. The system is addicted. But the risks have multiplied. First, complexity. Modern derivatives are so complicated that even the people creating them can't fully predict how they'll behave under stress. In 2008, mortgage-backed securities were sliced into tranches, repackaged, and turned into collateralized debt obligations. Then derivatives were created based on those. Nobody understood the full chain of risk. Today, derivatives are even more complex. Synthetic CDOs, tranche warfare, bespoke derivatives customized for individual clients. The complexity makes the system unpredictable. Second, leverage. The $600 trillion notional value doesn't mean $600 trillion is actually at risk. But even if only 1% of that is real exposure, that's $6 trillion. If 5% moves against the system, that's $30 trillion, more than the entire US economy. Third, counterparty risk. The system is more interconnected now than it was in 2008. Every major bank trades derivatives with every other major bank. If one fails, the losses spread instantly. And here's what makes this crisis different from 2008. In 2008, governments could still print money to bail out the system. Interest rates were above zero. Central banks had room to cut rates and inject liquidity. Today, many countries have spent years at near zero or negative interest rates. Central bank balance sheets are already bloated from years of quantitative easing. Governments are drowning in debt. The next time the derivatives market explodes, central banks won't have the tools to stop it. They can't cut rates that are already at zero. They can't print money without triggering hyperinflation. They can't bail out a $600 trillion market. The system has become too big to save.
So what triggers the collapse? The truth is, nobody knows exactly. But history gives us patterns.
In 1987, it was portfolio insurance derivatives and a sudden market drop. In 2008, it was mortgage defaults, triggering credit default swaps. In 2025, there are multiple possible triggers. First, interest rate shock. Trillions of dollars in interest rate derivatives are based on rates staying low and stable. If rates spike suddenly, those contracts move against the banks holding them. Losses cascade. Second, sovereign debt crisis. Many derivatives are tied to government bonds. If a major country defaults or restructures its debt, credit default swaps trigger. Banks that sold those swaps face instant losses. Third, currency collapse. Trillions in currency derivatives. If a major currency like the dollar or euro loses confidence rapidly, currency swaps and forwards explode. Fourth, credit event. If a major corporation or bank fails unexpectedly, the counterparty risk spreads. Every institution that traded derivatives with the failed entity takes losses. The system is so interconnected that any one of these triggers could start the cascade. And unlike 2008, where the problem was concentrated in US housing, the next crisis will be global from day one. China has a massive derivatives market tied to real estate and manufacturing. Europe has trillions in sovereign debt derivatives. Emerging markets have currency derivatives that explode when the dollar strengthens. When one domino falls, they all fall. And the speed will be faster than 2008. In 2008, Lehman collapsed over a weekend. Markets had time to react. Today, with algorithmic trading and instant global connectivity, a derivative meltdown could happen in hours, maybe minutes. By the time regulators understand what's happening, the damage will already be done.
When the derivatives market collapses, it's not banks and hedge funds that suffer most, it's ordinary people. Your pension fund holds derivatives. Your insurance company uses them to hedge risk. Your bank trades them to manage interest rate exposure. When those derivatives fail, your savings are at risk. In 2008, millions of people lost their jobs. Retirement accounts dropped 40 to 50%. Housing prices collapsed. And that was with $29 trillion in global bailouts. The derivatives market today is 10 times larger. There is no bailout big enough for $600 trillion. So what do? First, understand that cash in a bank is not safety. Banks are massively exposed to derivatives. If a major bank fails, deposits above insurance limits could be at risk. Diversify where you hold cash. Second, avoid financial products you don't understand. If your advisor is recommending complex structured products or leveraged investments, ask questions. If they can't explain it simply, don't buy it. Third, own assets with intrinsic value. Real estate that generates income. Productive businesses with real cash flow. Commodities like gold that can't be printed or leveraged into oblivion. These assets survived 2008. They'll survive the next crisis. Fourth, watch the indicators. Credit spreads widening. Liquidity drying up in bond markets. Sudden spikes in volatility. Banks restricting lending to each other. These are early warning signs. But here's the hard truth. Most people won't see it coming. In 2008, the crisis seemed to happen overnight. One day the economy looked fine. The next day Lehman was bankrupt and the world was in chaos. The derivatives time bomb is hidden in plain sight. $600 trillion of interconnected bets that nobody fully understands. Warren Buffett called them weapons of mass destruction in 2003. 22 years later, the weapon is 10 times bigger and pointed at every economy on Earth. The explosion isn't a matter of if, it's a matter of when.
3 financial crises. 1987. The derivatives market was $1 trillion. 2008. It was $60 trillion. 2025. It's $600 trillion. Each crisis 10 times larger than the last. The pattern is clear. Derivatives create leverage. Leverage creates instability. Instability creates crisis. And every crisis requires a bigger bailout than the last. But this time, there is no bailout big enough. Governments are already drowning in debt. Central banks have already used their ammunition. Interest rates are already at zero. When $600 trillion in derivatives start unwinding, the blast radius will be global, immediate, and unstoppable. Banks will fail. Pensions will collapse. Currencies will crater. Credit will freeze. And most people won't understand what happened until it's already over. Warren Buffett was right. Derivatives are financial weapons of mass destruction. And the weapon is now 10 times bigger than it was when it nearly destroyed the world in 2008. The timer is running. The question isn't whether it will explode. The question is whether you'll be positioned to survive when it does. Subscribe to track the indicators as the crisis approaches, because the next explosion won't give you a second chance. The $600 trillion time bomb, and the countdown has already begun.